We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Lior Gantz. He's the founder of Wealth Research Group. How are you today, Lior?
I'm good. Thank you for having me.
Thanks for coming back on. So we're going to start by speaking about something that's obviously on everybody's mind here. And you guys at Wealth Research Group created a downloadable report for our audience, available at wealthresearchgroup.com/squeeze, about everything to do with the silver squeeze. So why don't we start by kind of talking about other times in history when silver was squeezed and what happened as a result here?
Okay, good question. And I want to say that silver is a very unique metal because it's ingrained at least within the baby boomer population, that silver can be squeezed. Because what they remember is the 1970s. In 1971, when the gold window was closed, silver was trading for $1.92. And by the end of the decade, in 1980, it was trading for 50. And what happened in 1979 is that the two oil tycoon billionaires, the Hunt brothers, loaned about $3 billion at very low rates, very low interest rates, and also persuaded a bunch of their wealthy friends to buy up as much of the silver supply as possible, thinking basically that they can corner the silver supply globally. They actually ended up at the peak of it, owning about a third of global supply of silver. It's pretty insane because they had to warehouse the whole thing. But it did create such a price spike, and this is a commodity, which means that it's not owned by anyone, right? It's not a publicly traded company or a private. It's not an entity. Mm-hmm. So it affects the lives of millions of people because obviously silver has many industrial uses and otherwise. And so the government intervened. The government, if you think about what happened recently with Robinhood and other platforms that didn't allow GameStop to trade freely, the government banned long contracts on silver. It only allowed shorts. And then they also told the Hunt brothers to unwind their positions. They gave them like a schedule and everything. And then this caused the famous Silver Thursday, which was a big sell-off in silver. And the Hunt brothers obviously did not win this squeeze. So that is ingrained in the baby boomers generation. Now, fast forward to 2008, we remember that it went from 21 an ounce to 9 an ounce when Lehman Brothers went bust, and they had to basically hand over their commodities desk to another firm. And then all these allegations started to appear and surface about either bullion banks in London or in New York that are suppressing the price of silver. Now, what is that all about? What ended up happening is that the CFTC found out that traders on the commodities desk for these bullion banks did what's called spoofing. And they basically created either giant sell orders or giant buy orders, which they never intended to actually execute. But when you look at these trading platforms, you can look at what's called level 2 or level 3, where you see that you don't actually see that on the bid and ask if you look at a regular platform. But if you look behind the scenes with more sophisticated platforms, it looks like there's a big seller out there. And so it kind of scares away buyers, etc. For 10 years, they've investigated JP Morgan on this. And about a year and a half ago, they fined them $960 million for doing that and changed a bit of the rules. So the CFTC now has rules where if they even suspect that you're doing something to influence the price, they can stop you. They don't need to have any proof. If they have just a suspicion. So that's one thing about the silver squeeze that is important to consider. One, the government may intervene. Two, the CFTC rules have changed. Three, there are so many things that with futures and ETFs are hard to transact. If you really want to corner this, you need to you need to create like many transactions. They're going to restrict the amounts that you can do. They're going to restrict the fact that you can settle or let your futures contracts expire and ask for delivery. There are all sorts of things that make it literally impossible. So what you ended up seeing was that bullion dealers ran out of supply. The premiums on physical silver shot up, but not the paper contracts. And that's what I think people need to understand. The trying to squeeze silver because of either one, the fact that there's so much more derivatives and paper contracts out there than real physical supply. That's true of every commodity. That's not even just true of commodities. If we all collectively, a Reddit group would say, everyone go to the ATMs, let's all clean our savings, then there will be there won't be enough paper currency out there. So it's all leveraged. But it's leveraged for the actual design of it is to be leveraged for a good reason. The fact of the matter is that there are banks that abuse this leverage, but the idea of it is to make sure that supply and demand, are sort of coordinated. Because man, the 5,000 industrial uses for silver, that's a lot. Copper, if you think about it, is a huge market. If you don't have these ways to hedge, as governments build huge infrastructure programs, they need these sophisticated tools to do that. So that's why the paper markets are there. But if you abuse them, then that creates not only hatred, but a lot of animosity towards these big institutions that do that. But the actual short squeeze, Tom, sorry, just to finish, the actual short squeeze, in GameStop or something like that, there was 140% of the float or the market cap. It was a naked short. Mm-hmm. In silver, there is no naked short. There's a few big short positions, but they're definitely not naked or anything like that. I think the price of silver is going much higher, but it doesn't have anything to do with Reddit. It has to do with big, fundamental, global catalysts that are in motion.
So what I wanted to ask there, Lior, is what do you think the motivations are of some of these big, let's say there's four big institutions that are shorting silver. What do you think their motivations are?
For the most part, their motivations is to make money. So, these are corporations that have to answer to board of directors and to shareholders. Their main angle is to try and make money. The fact is that commodities in general are in a permanent bear market throughout history. If you look at any commodity, over time, its price goes down because they find better and better ways and cheaper ways of mining them. Within this permanent 10,000-year bear market in commodities, there are cycles. There are boom and bust cycles. And the idea is just to catch the booms. So I don't want to speculate as to why these bullion banks or these institutions specifically short silver, but it's not something that I think about in terms of why they're doing it, because they, as you say, they may have more than one agenda. Mm-hmm. It could be to offset long positions that they have that are inversely correlated with taking a short on silver. So it's sort of a hedge. But who knows? I mean, definitely there's greed and the ability to make money that is part of it. But I think for the most part, silver is a quasi precious metal, quasi industrial metal that is priced right now in a way that is wrong. Mm-hmm. And I think that in the next 2-3 years, its price is more than likely to be one of the best performing commodities out there.
So how is it different this time, Lior? A much larger number of people this time are buying silver. So it seems that it would be harder for the powers that be to take the same steps as those that ultimately led to the destruction of the Hunt brothers.
Definitely. So silver, what's unique about it is that the baby boomers are fascinated with it and are loyal to it. There are people that will never sell their silver. But what happened right now with Reddit and with Elon Musk tweeting that they've bought $1.5 billion in Bitcoin and reserved the right to buy bullion, it's putting gold and silver on the mainstream of millennials and Generation Z, which are by far the most important investors going forward. Millennials right now comprise about a third or 33% of the American workforce. By 2030, they will be 75% of the workforce. They're going to become as dominant as the baby boomers were. There are more millennials with college degrees than there are baby boomers with college degree, which means that their salaries are likely to be about 30% higher as a segment of the population than the baby boomers was adjusted to cost of living and living standards. So the millennials have a chance to become an even richer generation than the baby boomers, which are the richest generation in history. And so there's a big shift here. All these QE programs that have happened in the past 10 years, they've created about $3 or $4 trillion in synthetic currency. And because it went predominantly to pension funds, retirement funds, sovereign wealth funds, insurance companies, etc., it went into bonds. So much money went into bonds, so many trillions. There has actually been a net outflow out of equities in the last 10 years in this bull market. So I think about $5 to $6 trillion are going to come back into equities in the next few years. And the big theme here is that emerging markets, what they saw in March of 2020 is that they cannot be reliant on the dollar anymore because it damaged their economy so badly and their currency so badly, having this dependency on this petrodollar system, that they are looking to become as independent as possible. And you're seeing a lot of emerging markets becoming having very strong and stable currencies. I think that's going to put a lot of pressure on the dollar going forward. And in our analysis, its index, the DXY, that tracks it against other major currencies, it's going to decline by about 20 to 25% from where it is. So you're looking at a situation where in real terms, US savers are going to lose purchasing power. You couple that with the fact that this generation that I just told you about, that are going to inherit a lot of wealth and inherit great paying jobs from the baby boomers, they have not started buying homes. They're either renting or living at home. They're mostly not married. They don't have children. I mean, the whole growth spurt that we saw in the 80s is ahead of us. And so what we think is that because of ESG restrictions, in other words, because of all of these left agendas of save the planet and let's make everything clean, etc., we're putting so much additional costs on mining companies that the cost to produce silver, which is badly needed for solar panels, and it's a clean metal. It's part of the clean tech new world, and it mining it in and of itself creates very little emissions. So it's also going to be very popular with the younger generations. I think that's going to impact the price of commodities. With silver in particular, I think the fact that we've entered a dollar bear market is going to be the most important catalyst for it. Now that you see Generation Z and millennials getting interested in gold and silver, specifically silver, I think that is a major catalyst for it, for sure.
So going back to something you said earlier, these global trends that are going to really push silver higher, a couple of those that you just mentioned, that's kind of the basis of what you're mentioning about these global trends to really drive silver?
Yes, I think one of the most important ones that I haven't mentioned is all of these policies about redistribution of wealth. You can call them stimulus checks, you can call them extended unemployment, and maybe they will actually call them later on universal basic income, but it doesn't matter. When you give money to the lower income demographics, and when you allow a lot of people to stay unemployed for longer, these demographics are not going to put those checks into the market or into real estate, etc. They're going to spend this back into the economy. And I think that's the big difference between the 2010s and the 2020s. In the 2010s, all of this synthetic currency went into the top 10% of the population, and they, said, okay, well, all of this cheap currency, I'm going to borrow, and I'm going to buy investment property. I'm going to buy stocks. I'm going to buy whatever can make me wealthy. They didn't set out and said, okay, I'm going to borrow and I'm going to pay for my utilities. These are not the same demographics. Now you have it where this is not monetary policy. This is fiscal policy, and it's monetized by central banks, which allow these deficits to occur at such low rates. But this money is actually funneled into lower income demographics, and they will spend it. And that's the big difference. That's the number one big difference. The second big difference is that we're going to embark on many infrastructure programs in the United States. And I think that is a huge catalyst. The most important thing is the fact that in the past 10 years, these very wealthy institutions have elected to allocate these funds into tech. And there has been a gross decline in capital expenditures for mining companies. I'm sure you know that it takes now about 20 years to put a mine into production. And I'm sure you also know that M&A activity has been very, very slow, save for some a few deals. And the fact that we know about these deals just shows you how slow it is, because every deal is like a big deal. And exploration has been steadily declining. I mean, companies just do not explore. And so for this thing to start turning around, which it is, it's going to take 2, 3, 4 years. Mm-hmm. And therefore, we think that once oil, do you remember, Tom, when oil reached negative $42 a barrel in April? That, to us, marked the bottom for the super bear market in commodities that started in 2011. That was the bottom. Since then, look at all commodities. Look at the commodities index. It's up about 75%. In January of 2021, it hit 5 new all-time highs. And so we're in a commodities bull market. We're just in the first inning of it. The problem that many investors had was that gold actually bottomed in 2015, but gold is not so much a commodity. It's a precious metal. It's a different animal. Mm-hmm. So that confused a lot of people. The actual bear market in commodities ended in April 2020, in our opinion. And now you're going to see commodities starting to go higher. I think that the other thing that people are missing is that they think that hyperinflation is coming in the United States. And it's just the probability of it is very low. If you put yourself in that box where you need to buy, your own vegetables and ammo and be a survivalist, etc., it's not where the United States is going. The United States is going to coexist with this amazing tech industry and these unsustainable deficits. It's going to coexist and continue to coexist until such time as fintech and other global forces are going to delegitimize the dollar hegemony. And at that point, it's probably going to be some sort of a G7, G20, whatever meeting that kind of changes the dynamics of the dollar as a reserve currency. But for now, with the dollar being about 60% of global transactions, it's the beast, it's the animal, and it's not replaceable with any other fiat currency. So you have to find another solution. And until such time comes, I think that we're in a dysfunctional marriage, which is better than a crazy divorce. So that's how I would put it. The underlying fundamental here for this situation is that gold has moved separately from commodities, and that's gonna change now, because now you see the entire commodity index moving in tandem. We've never had a situation, Tom, where save for two commodities that are not in a deficit, all other major commodities are in annual production deficits. Only cocoa beans and zinc are in a surplus and not in a deficit on an annualized basis. So major underinvestment for the past 10 years in commodities, and it's going to greatly change in the next few years.
So Lior, as you're talking about gold, you wrote an article about why the gold to silver ratio of 63 to 1 is such an important threshold. So can you share with us some of your thoughts around that, please?
Yeah, sure. And by the way, we talk about all of this in updated fashion and whatnot on our newsletter at wealthresearch.com. It's a free newsletter. It's basically, the idea of it is that I spend about 6 to 8 hours a day either researching macro or specific companies and talking with CEOs, and I try to congest that into 3 weekly articles. But anyways, the 63 to 1 is a big resistance level that has been forming for many years. And so if you see a clear breakout below that, then what's really important about that is that when you try to make any trades in mining companies, they track closely silver's price and not gold's price. Gold can move, and it has been moving for the past 5 years without us seeing a really big bull market in mining equities. When silver moves, mining equities really move. And so the 63 to 1 is really important, because once there's a clear breakout below that, or once silver becomes stronger than gold in a meaningful way, it brings a lot of speculative money back into mining. And it doesn't take much for companies that are just engaged in mining in general to really move with this type of environment. Just remember that if you take the market capitalization of the NASDAQ 100 compared to the 100 biggest mining companies, the comparisons are irrelevant. It's just such a smaller industry that if money flows from tech or biotech to mining, those are the big cycles here, tech or low tech, and these things move. And just to go back to what I was saying earlier, people think that hyperinflation is coming. I do not think so. What I think is that we have, the way that the Federal Reserve tracks it, we have about 1.5% inflation right now. If it moves 60% higher, which is a lot, to about 2.5 to 3% on the way that the Fed measures it, man, no living CEO has ever managed his company with 3% inflation in the United States. It's been such a long time that we've had low interest rates or zero interest rates, and just these crazy muted inflation periods, that I think that's a really big change. And that's going to introduce a lot of confusion into the markets. That's why I think also there's going to be a big shift into commodities, because there it's straightforward. Inflation brings up the price, make more money. It's easy to see the bottom line.
Interesting. So Lior, what kind of metals prices are you guys targeting for, let's say, 2021 here? And what are some of the best ways, in your opinion, to kind of profit from the fact that the metals, or from your target prices for the metals?
Well, first of all, Wealth Research Group is a newsletter that doesn't just focus on gold and silver. If you go to our website, on the top menu, you will see that there's a button that's called watch lists. And those watch lists there's 8 now, because we just published one 4 days ago. And they're basically watch lists of companies that we started publishing in April 2020. And then we had another one in June, August, September, October, December, January, and February. And each one of them has some information about certain companies. None of them are mining companies. And man, some of them, what we do is we have also a limit price. So we said, hey, if they're great companies, but they need to reach these prices for us to get interested. Those that did go down to those limit prices, I mean, some of them from December are already up like 400%, or 300%, 200%, 150. Amazing results, and they have nothing to do with mining. Mm-hmm. Now, with mining, and you can go and download these. You can look at all of them. With mining in general in 2021, we do think that gold has a chance of eliminating the previous all-time high of $2,000.69 from August 6th, 2020. We do believe that can happen. We don't know. It doesn't have to do with the calendar year. It can happen, in the summer. It doesn't matter what the price will be at the 31st of December so much. But we do believe that gold has a big chance here. Mm-hmm. What will really move it is an overheated economy. So as we see the economy opening up, and as we see vaccinations come through, the $1.9 trillion package, and then infrastructure, all of these are very familiar to us. They're very familiar. They're like 2011. They're like, this is where inflation can kick it into higher gear. And we don't need inflation to actually do anything. We just need the whiff, the scare, the initial idea that, man, it could happen. And then the Fed saying, even if that happens, we're not going to raise rates. That's going to really ramp it up. Mm-hmm. For silver, not so much all-time highs, but definitely we look at 30 as a really important point. Whereas if it surpasses 30 again, we see it going up pretty fast to about 33 to 35. So that's where we see silver this year if it has a good year. What will help silver? If the dollar continues to go down. That's the main thing. Secondary thing is if oil continues to go up. I don't know if you've ever plotted oil and silver on top of each other. They're pretty much 93% correlated. I'm blindly saying this, but they're over 90% correlated. It's just amazing. So oil prices going higher, it's a really good sign for silver prices. And we also think that in general, silver is a commodity that is very unique because its current price is so much below its all-time high, and it's been so many years since it's seen a surge. So there's a lot of things going for silver right now. I think between 33 and 35, somewhere throughout the year is very plausible. On the flip side, we don't see it coming down that much. So that's another thing to consider here. The risk reward is pretty good because the downside to us is very, very limited. There are very few things that will create a bear market or a sideways market or just a downward trend in silver. So that's what I think about those two. In terms of how to play this, I personally don't look at physical precious metals, Tom, as a way to make money. My personal strategy is I took 2 years worth of my lifestyle burn rate, okay, and I converted that fiat into physical gold and silver. So just for hypothetical mathematics, if the family burn rate is about $5,000 a month, I take that times 24 months or 2 years. That's $120,000, and I converted that fiat currency savings into physical precious metals. The reason I did that is if all of the major gloom and doom predictions ever come true and there's a 2-year depression, well, hey, I got 2 years worth of current standard living expenses tucked away in gold and silver. So that's me that. Now, I would raise that if my net worth goes to a point where I think it's worth it to just do 10% of my net worth or something like that. Okay, well, that's one thing. Mining equities or gold companies, silver companies, etc., that's where I like to just trade. These are companies that are very much cyclical. You try and find the ones that are beaten down or mispriced, and you later exit them on any type of major news that you think is so important that it might be changing the risk-reward dynamics of that company. It's obviously much different than buy and hold dividend type investing, but man, if it works, it really works.
Interesting. I want to go back to something you were mentioning, Lior, about the oil price helping the silver price. Isn't that, let's say, or shouldn't it be negatively correlated, considering that if the oil price goes up, the raw cost of getting that ore out of the ground would also go up?
Exactly.
So why would that help the silver price?
Because as a mining company, it raises your costs, and then you need to sell it at a higher price. It just raises everything in society. It creates inflation, which is the predominant reason for silver prices to go higher. Higher oil prices affect many things, but the thing that they affect most is how people perceive inflation. The thing is that inflation in our day and age, it's compartmentalized. So if you can see inflation in the stock market or in the real estate market, what I'm talking about is broad inflation, where Tom wakes up and says, man, there's inflation out there. Like I should buy things now and not a year from now. Now, if you don't think that, that's because you don't really believe there's inflation out there. But I think that there's a growing segment of the population that I speak with that think that prices are heading higher because of coronavirus, basically, because everything was closed. When you reopen everything, things are going to go and be priced for more. If you just think about airline tickets, because they had to retire so many planes and whatnot, and supply chains. Supply chains are moving from a globalized world where you literally open up a map of the world and say, hey, where's the cheapest price? Where's the cheapest location to manufacture? They're moving into a world where countries want to manufacture in-house, and that is more expensive. So the world in general, because of the virus, is becoming more expensive. And I think that once people start to notice it more, and they say, food prices have gone up, and this has gone up, and toys have gone up, and this, then there's a real chance here for money velocity to kick in, and for these commodities to continue to go higher. That at least is our analysis of what's going on.
Yeah, that's a perfect clarification there, Lior. Do you have any concluding thoughts as we wrap up here?
I would just say that I like it that Elon Musk is bullish on gold. It's helping us. It's insane how much influence a tweet can have, or just in general, one person saying something can move so much, because everything is so everything is disseminated this quickly to everyone, that you have a person saying something, it immediately goes into the minds of billions of people. That is really a lot of power. And I think that what the coronavirus has done is it sort of created a reject of globalization. I thought in March that, like, the day after the WHO said pandemic, that the G7 would meet, the G20 would meet. What's the first thing that happened? The first thing that happened is that Trump said, we're going to defund the WHO. It's China's fault. And then other countries were saying, we're going to close borders. Everything became so nationalized and not globalized. And I think that people have rejected globalism. And that is one of the most important themes going forward, because a country like China is now not going to be the center of manufacturing for everyone else. It's going to start to shore up its reserves. There's an arms race for commodities right now in the world, and that's a big reason that commodities are going to keep going higher. I think that and not Reddit is what's really important for commodities.
Interesting, Lior. Tell our audience where we can find more about you. Is it just that wealthresearchgroup.com?
Yes, exactly. That's
Perfect.
the best.
Excellent. Thanks very much for your time today, Lior.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.